Stellar start to the week for the Indian markets as the benchmark indices zoom more than 1%. Auto and consumer durable stocks rise on GST relief news. Broader markets in line with the benchmarks.
Prime Minister Narendra Modi on Friday promised next generational GST reforms by Diwali, which will bring down the tax burden on consumers as well as MSMEs. Autos, ACs, consumer durables, textiles and apparels, as well as insurance stocks see a significant uptick.
India's ferrous metal stocks, they do well in today's trading session. Tata Steel, JSW Steel, SAIL, JSPL among others gain after the DGTR recommended a final safeguard duty on steel imports for the next 3 years.
And shares of Knowledge Realty Trust lists at a 4% premium to its issue price. We will be speaking to the management shortly. Stay tuned in for that conversation.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Vinny. And Vinny, you know, the bulls are busting the charts today. We have a net short market. You have ample amount of liquidity with regard to domestic mutual funds. And the bazooka shot that's coming from Prime Minister Narendra Modi, acknowledging there is some softness on ground and giving consumption a bit of a booster shot. I think that's looking good.
Absolutely. That's looking very good. And good morning to you, Nigel, as well. So a good day coming in for the markets. And let's not forget, last week also, we actually snapped that 6-week losing streak for the markets. So today, surely starting this week on a positive footing, advance decline ratio obviously clearly in favor of advances versus declines today. The only sector that's seeing a bit of a muted performance is the Nifty IT. Let's just pull that up. That's the only one just trading with mild bit of a cut as of now. Other than that, autos, realties, the GST boost and rationalization that could come in is something that is keeping the stocks and the markets abuzz as well. A lot of movers in terms of earnings as well that we have. Zaggle Prepaid, they reported their numbers. Keep an eye out on that one. Vodafone Idea was a muted set, but we're seeing the stock is buzzing in trade. Do not forget, it's a beaten down stock as well. But Vodafone Idea, that's the one to keep an eye out on. SP Apparels in the textile space, that's buzzing away as well as Borosil Limited reported their numbers as well. All these stocks are buzzing on the back of their earnings. So interesting day, a lot of movers on the mid and small cap as well. And overall, the broader market is doing quite well.
Well, that's right. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu joins us to tell us about a stock that he's tracking closely. Anubhav?
Well, we are looking at the CRDMO player Sai Life Sciences, which appears to be ahead of its medium-term guidance given the execution in Q1 results. Now, we remain constructive in this space simply because drug discovery and development requires huge cost and incredibly long time, which makes it pertinent to have cost-effective CRDMO partners. And to provide a context, nearly 2/3 of this industry is still concentrated in Europe and the US, while India's market share is just 3.5%, which provides a long runway ahead. Now, among the key long-term drivers for the company are its differentiated delivery model, wherein research labs are located close to innovation hubs in the US. Secondly, companies investing in new modalities such as peptides, antibody drug conjugates, lipids, etc. Now, it is estimated that about 40% of the industry-level growth would come from such modalities in the medium term. In addition, a healthy balance sheet and operating cash flow provides enough room for the capex plan and the expansion of scientific talent pool. Now, companies on track to add more than 70% plus capacity by Q3 of fiscal 27. That said, US tariff uncertainty is one key risk to watch, and also after recent run-up for the stock, investors should wait for better entry levels, in our opinion.
Okay, thank you so much for that. But let's move on and talk about today's debutant on D Street. We have Knowledge Realty Trust that made its debut, and it's listed at a premium of 3 to 4% versus its issue price. Now, we have the management of the company joining in with us, Shirish Gorbole, CEO of Knowledge Realty Trust, as well as Vijay Agarwal, Managing Director of Sattva Group, joining us to discuss the outlook and the way forward for the company. Gentlemen, good morning and congratulations on your listing now. And, you know, now since you're listed, let's start by talking about your expansion plans. We've spoken about where the funds are going to be used, repayment of debt, especially this is coming in for your assets, that is for the SPV side. Now, talking about the way forward, what about the expansion plan? 29 assets you all have across 6 cities. Which is going to be the biggest market? Where are you going to be focusing on? Bijay, if you could start with that.
Yeah, thank you for calling us on this thing. We've been able to acquire the next 18 months at least 3 to 4 assets. This is our acquisition plan. And why we are so bullish on acquisition? Because this is a brand neutral platform. So anyone, any developers, any HNIs can join, and they can we can offer them to sit, and then they can able to be put their logo, they can continue with their brand. So that will be anyone's desire will be that they can see that their brands and all. And Knowledge Realty Trust provides that platform to anyone who can join us, and brand neutral. That is the best benefit of this REIT. And we are very bullish on the new acquisitions.
Okay, all right. Hi, gentlemen. You all are quite excited. I think if I got that correctly, you said in the next 18 months you'll acquire 3 to 4 assets. Is that correct?
Yes. Yes.
All right. Break it up for us geographically. What would your geographic preference be when you're looking to expand?
Sure.
Yes, sir. Please go ahead.
Just say that, Mr. Agarwal is very, very positive and optimistic. We're going to work hard. Hopefully, we will make those 3 or 4 acquisitions in the next 18 months. We're going to make sure that they're accretive also. So we're not just, acquiring for the sake of acquiring, but this will help our DPU and this will help the company. And as far as geographically, I think, we are in the top 6 cities in in India already. And we're going to make sure that we continue our focus on the larger cities. Obviously, there's Pune, Calcutta, some other cities out there which we could expand into. So we're going to keep our eyes open for acquisitions. But that's the focus for now. And so that's where we are.
Okay, so that's going to be in the larger cities. This expansion that comes in as of now is going to be in the top cities where you all are currently present, right? Sirish?
So currently present, we are also not present in Pune and Calcutta. So
that's where you will add
potential cities we expand into. It really depends on the opportunity, right? I think it's if it's accretive and if it helps our DPU, we'll make the acquisitions in the larger cities, because that's the demand in office. The office demand is in the bigger cities. Tier 2s will happen, but till today, still the larger cities have the opportunities.
Okay. And now, there are concerns coming in from that IT side as well, right? Some bit of those layoffs. What's your exposure to that? And, could that, slow down a bit in terms of expansion or the cities that maybe you are looking at right now?
Go on, sir.
In our portfolio, the IT has been very minimum, less than 10%. And we believe that India is a dollar rent. And dollar rent will not go anywhere wrong, because we are 82% less than the US market in the rent wise. So where will go wrong? And this, we have not only the IT, the 10%, we have in financial, GCC, GCC and other sectors also. So IT has been very minimum. So we don't see any risk in this portfolio.
All right.
And while IT, has had a bit of a slowdown, if you look at the Global Capability Center story, the GCC story, that's a trend that's developing and we think will continue to develop. And what drives GCCs is really the fact that technology has become so important, not just in technology companies, but in every company, right? And so therefore, GCCs are very important for all corporations, not just North America, but also Europe and Asia. So we're very comfortable and confident that despite maybe a slight slowdown from the IT world, our office demand will continue.
All right. The NOI is expected to move, I think, from around 3,400 crores to around 5,500 crores by 2029. Could you tell us what is the yield expected? And if you could tell us what will the area under management look like by 2029? Yield and area under management. Please go ahead.
Yeah. So, we have a stabilized yield of 7.2%. Okay. And that we, project to expand and grow from 7.2 to 7.7 and then up to 8.2 and so on, with the growth in NOI, as you pointed out. And in terms of square feet, we have out of the 46 million square feet, 37 million square feet today is built and constructed. There is 1.2 million square feet that is under construction. So the current NOI projection that we have is simply including the 37 plus the 1, so 38 million square feet of total space from our side. This does not include acquisitions, as Mr. Agarwal pointed out. Hopefully, we make these acquisitions in the next 18 months, and that will only further increase our NOI.
How much would that increase it by if you make those acquisitions in the next 18 months then?
Well, it depends on the accretive nature of it, right?
And rent
Because,
also.
Today, what's happening is rents are going up, as Mr. Agarwal is saying, and if the rents continue their climb and we are able to make accretive acquisitions, it's really hard to put a number. Obviously, it depends on the specific acquisitions and the numbers at stake. But clearly, that's going to be additive, further adding to what numbers we are projecting here. That's sort of...
Yeah. How often are these rent prices revised, if you could give me that as well. So, I would understand about the rentals, how do they move out?
So, all sort of leases typically have an escalation clause. In Mumbai, we typically have shorter 5-year leases, and there are annual escalations of 5% each year. In Bangalore, Hyderabad, some of the southern markets, the lease terms are typically longer, and we have escalations every 3 years. Now, it's 15% approximately. Some are slightly less, but approximately 15 every 3 years. Okay. So it presents an opportunity for the rents to go up. And also, I might remind you that, our portfolio, the rents we have are way below market. So not only are we getting escalations, but we're also getting a mark-to-market. So we have rents which are 20% plus below what market rents are. So as these leases mature, our rents will grow in addition to the escalations that you were discussing.
Normally, we're seeing it that whenever any tenant goes and the new tenant comes, at least 15 to 20%, as Mr. Sirish said, that 20% we get the extra rent. So that is the additional benefit apart from the normal increment of 5% in a year and 3 years in 15%. This is the benchmark of the industry, real estate industry, of the leasing industry.
All right, gentlemen, congratulations on the listing. Thanks for detailing your plans for the next few years. We wish you all well, and we look forward to interacting with you all as this journey progresses for you all. Thanks a lot for joining in. Well, time to slip into a short break. On the other side, we have Gautam Dukad of Motilal Oswal Financial Services, who's waiting for us. He'll give us his view on the markets post the recent big measures that have been announced. Stay tuned.
Welcome back, and you're watching Chartbusters on CNBC-TV18. Now, sources are saying that GST Council nominated group of ministers on rate rationalization is set to meet on 21st of August. That was the biggest news that we had that came in over this long weekend. Timsy is joining in with us to give us more details on this front. Timsy?
Well, yes, as you rightly mentioned, that the ball is now in the court of group of ministers, and the group of ministers, there are 3 panels which are likely to meet this week itself, which includes the GST nominated group of ministers on compensation cess, which is meeting on 20th of August, the group of ministers on rate rationalization, the big rate overhaul that we are likely to now see to be discussed by the group of ministers. Only then it can go to the GST Council. That is likely to meet on 21st of August. And the other group of ministers, which is also a very crucial group of ministers on life and health insurance, that is also likely to meet on 20th of August. We'll have to see, because this group of ministers' meetings are so crucial that only based on these recommendations, the proposal will then be deliberated by the GST Council. The rates panel meeting on 21st will discuss reduction of slabs, overhauling of the entire GST rates, whereas the panel on compensation cess is going to discuss what should be the way out, what should be the future of compensation cess, and if compensation cess payouts, that is for the back-to-back loans which were taken during COVID time to compensate the states, if the payout ends early from March 2026 to, say, by August by October or November, then what happens to this levy? How soon this levy will end? And what should be the future? And the other one, the big panel on health and life insurance, as to what should be the relief that should be given, what should be the rates that should be charged on premiums of life and health insurance. So 3 crucial panels meeting this week, one on 20th, the other also on 20th, and the third big one on rates on 21st of August.
Okay, all right. Thanks a lot for joining in, Tim C, and filling us in with that crucial information with regard to the insurance space. Let's get in Gautam Duka, though, Head of Research Institutional Equities of Motilal Oswal Financial Services, who joins us on the show. Hi, Gautam. Good morning. Good to see you in. It's a rainy day, which may not be so bad because the monsoons have been pretty okay. Earnings are expected to pick up, and now you have a couple of these bazooka shots coming out. The GST rationalization as well as the S&P upgrade came out of nowhere. Tell us, do you think the Indian markets, after a year or so of underperformance, do you think we're bracing for better times? And in terms of earnings growth, what are you projecting now?
Hi, Nigel. Good morning. Thanks for having me. Yes, monsoon is picking up, which is a very good news. And as you rightly mentioned, after a long time, we've seen over a long weekend, 2-3 very big positive news items coming out, and which has at least lifted the sentiments. For last 12 months, our markets have gone absolutely nowhere, and for right reasons, because the earnings also went nowhere in FY25. As we discussed a month back when we were publishing our preview, that FY26 will be a far better year on earnings than FY25. And first quarter has already turned out to be slightly better than what we forecasted. So we've got about 10-11% growth for our coverage universe, 8% growth for Nifty, which is slightly better than expectation. And as we've been discussing for last 2-3 months, mid caps continue to outperform large caps on earnings. So this quarter, again, if you look at our coverage of 311 stocks, the large cap, which is about 92 stocks that we covered, have posted 10% growth. But mid caps have posted close to 25% growth. Now, even if you exclude one OMC, which has created a very disproportionate influence on the final aggregate number, even then, the earnings growth is about 18% for mid caps and 10% for large cap. Whereas small caps are still struggling because of the issues in some of the financials pertaining to NBFCs and microfinance. So small caps on a reported basis for 132 companies that we track, their earnings have declined 11%. If you exclude financials, then the small cap universe of about 104 stocks have also posted 14% earnings growth. So clearly, we are looking for a slightly better year on corporate earnings. As it is for the last 6 months, government has taken several actions along with RBI, both on fiscal and monetary side. Government had cut income tax rate, RBI has cut interest rate, CRR, a lot of liquidity infusion has happened. Now this GST rationalization, the monsoon is good, and the festive season is around the corner. So hopefully in the second half, FY26, as we enter there, the cumulative impact of all these actions that have been taken so far will start making their presence felt.
Absolutely. Gautam, good morning. This is Vinny joining in the conversation as well. So obviously, given all these positive triggers that have come in, do you think that consumption is something that will be leading the story, especially in FY26 and the rest of the year now?
Absolutely. I mean, the focus of government has clearly shifted from capex to consumption. This was very much evident in the budget. And government has put up a lot of efforts on capex in the last 6 years. 6 years back, the total capex budget of Government of India used to be 1.9 lakh crore. FY25, they spent about 10.2 lakh crore. So that's almost a jump of 5x. Now, you can't keep growing at 20-30% on capex allocation by government on that kind of pace. So very prudently and wisely, they shifted the leverage lever away from capex towards consumption, which is why the potential 1 lakh crore of benefit through income tax reduction augurs well for consumption. However, what has also happened is consumption has been weak, especially on the low ticket side, especially on the staples, for last 10 years. It's not just last 1-2 years phenomena. As I keep repeating, there's not a single consumer staple company in India which has given 10% top line compounding for last 10 years. We just published a review note on consumption today morning. Again, we've given a lot of details on that. Even if you see that note today, there is not a single company which has given 10% top line compounding for 10 years. So consumption needed a support, especially low ticket, right? And that you've got now from multiple announcements already. However, from our point of view, we've been more bullish on consumer discretionaries for last 4 years. And that call continues from a next 1 to 3 year point of view. Short term, yes, staples should bounce back because the commentary in 1Q was slightly better than what we anticipate. There is some pickup in urban growth, which is happening. Rural has been strong for last 3-4 quarters. So staples should also join the party. But after the initial 5-10% rebound, I think, again, people will start looking at volume growth, how all the announcements are actually translating into numbers. Whereas for discretionary consumption, I think the road is very clear for next 3 to 5 years, which is why in our model portfolio, we are disproportionately overweight on consumer discretionary.
Okay, all right. Discretionary over staples. That's Gautam's call. Gautam, give us a few names. Trend is something that you all identified early. The stock had a one-way move before pulling back. If discretionary is going to do well, is that one of your top picks? If you could give us, what's the outlook with regard to stocks? How do you play this discretionary basket? And also, there was this EMS place that suddenly got very jittery after PG Electroplus went ahead, and cut their guidance. But clearly, RAC sales will move up. Then these guys as well will benefit. What's your top idea over there?
Yeah, so that's why you're seeing EMS companies, rallying today, including PG Electroplus. While we don't have coverage on PG, but we have coverage on 8 other EMS names. Our preferred ideas there are Dixon, Keynes, and Amber. They are also doing well in today's trade if AC sales go up. And even otherwise, outside of this GST announcement also, they were growing at a very fast clip. I mean, EMS as a pack this quarter posted 58% earnings growth. As regards our choice for discretionary consumer companies, in our model portfolio, we have 5 of them. Titan, which has been our long time favorite, obviously remains our favorite idea. They posted very strong set of numbers too. We like Page. We've been a big fan of Indian Hotel for last 4 years. We've been holding Indian Hotels. Then we have introduced Jubilant Foodworks in our model portfolio recently. Page Industries is there. And aside of that, we also have a positive view on Indigo Airlines and Varun Beverages. So there is a whole host of ideas in consumer discretionary, Nigel. You're spoiled for choice there. Unlike in staples, where you have to still shuffle between 7-8 companies. In discretionary, you have 50 potential investable ideas. And my sense is that as we move forward in next 3 to 5 years, as our per capita moves from $2,800 towards $4,000, you will see another 100 ideas coming up and listing.
Okay, interesting. 50 plus choices, spoiled for choice in the discretionary side of consumption. Gautam, thank you so much for joining us this morning, giving us insights in terms of markets and how the story of consumption is going to start playing out in this year as well. But on that note, we're going to step into a very short break. We'll get you more on the markets and stock-specific action, I beg your pardon, after this break.
Welcome back. Well, markets hold on to those gains. As you can see, all the top indices, well, it's only green on the screen. So the screen is looking good. We've come off a little bit from the top. But by the time we wind up today, you'll want the Nifty to end closer to around that 25,000 odd mark. We've completely run out of time on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.